Hey, welcome back to the Consulting Mind. Today I'm going to share with you why inflation matters so much to investment. To start with, let's talk about what is inflation. Basically, it is a measure of the changes of average price level of a selected basket of goods and services during a certain time period. Usually, it will be measured in the form of CPI, the Consumer Price Index. So what inflation can tell us and what important message can be obtained from observing the changes in the inflation? Basically, inflation can show us the aggregate demand and supply level. And what does that mean? There are millions of goods and services available in a society and in an economy. It would be impossible to observe every single one of them, and it is quite complex to do so. So instead of going through one by one of each individual good and services, rather it would be better and easier if we can have a broad index, a bucket that can be acted as an approximation for the overall price level. And the price level, the overall CPI, is basically comprised of two key factors, which is demand and supply. The demand force and the supply force will confront each other, and eventually it will come up with a net equilibrium, which can be further reflected into the inflation or the CPI. Just take the US as an example. During the COVID-19 period, obviously we can imagine that the demand will be hurt substantially because the unemployment rate is rising, the income is dropping, and economy is getting bad. So obviously the demand will be affected, but also at the same time, the supply will also be affected or precisely will be reduced because during the lockdown periods, as people cannot come to work and the provide and the supply of goods and services will also be reduced accordingly. So whether or not the demand will have a bigger impact or the supply forces will have the bigger impact of the overall economy, this will be able to reflect it in the overall CPI results. And when it comes to inflation, there are two types of inflation. One is demand pull inflation. Essentially, it means that when the people have more income, more capability, and more willing to have more purchase of goods and services, it will trigger up the demand pull inflation. And on the other hand, there are cost push inflation, which is due to the increase of the price of the raw material, the increase of the work in progress, such that the cost will be driven up, and as a result lead to the cost push inflation. Well, there is a very close and dynamic relationship between the monetary policy and the inflation. Usually, when the central bank is setting or considering reviewing their monetary policy, inflation will be a very key target consideration and an indicator to reference because in those mature and developed countries like US, usually they will set a 2 to 3% annual inflation target. And when the inflation rise above 2 to 3% of the annual inflation target, the central bank will usually tighten the monetary policy to reduce the monetary supply in order to cool down the economy activity, the lending ratio, and in order to curb the potential hyperinflation. And when the opposite happens, it means that when the inflation fall below 2 to 3%, it means that there will be more capability and room for the central bank to roll out more stimulation monetary policy. But overall, the central bank will be aiming to maintain a price stability when it comes to inflation. They don't want a fluctuated inflation. Instead, they want a more smooth and a more predictable one. And when the central bank did change the monetary policy, it will affect the monetary supply. When they change the key interest rate, like the Fed fund rate, effectively, they will change the price of the money of the overall and the whole market along the different channels, passing by different distributor and the commercial bank. And eventually, it will affect the level of borrowing, saving, spending, and in an economy. And ultimately, the monetary supply will also affect the inflation level. So, having understanding the inflation impact toward the overall macroeconomy, how about on individuals? Will it affect your own saving? And the answer is definitely yes. Uh, if the inflation rate is more than the interest rate you earned on your own saving account, it means that you will be losing your money. And what does losing money mean? It does not necessarily mean that the bank will deduct the money from your account. Rather, when we say you are losing money, it means that you are losing the purchasing power. Let's take as an example. Uh, Assume that you have $10,000 in a U.S. bank account, and there is 1% interest rate. It means that $100. But the CPI over the same period of your interest earned will be 2%. It will imply that there will be a net loss of 1% of your purchasing power due to the inflation. So having understanding the impact of the inflation, is there any way that we can protect ourselves or hedge ourselves from the inflation? The answer is yes. There are a couple of different ways that we can protect ourselves during the inflation period, and I'll list out some examples for your reference. The first one will be tips. It is the Treasury Inflation Protected Securities issued by the U.S. Treasury. It is a type of U.S. Treasury bond and are designed to index to inflation. It is purposefully designed to protect the investor from inflation. When there is a high inflation, the price of the tips will also be higher, simply put. And the second type will be commodity. It refers to a broad category that might include grain, precious material, electricity, oil, different sort of meat, different sorts of juice, and natural gas, and etc. There's a very special and unique relationship between commodity and inflation. Normally, we will consider commodity as a very valid indicator of inflation. So when there is a potential inflation, usually it will be and it can be reflected into the price of the commodities. And the third possibility will be gold. Usually people will consider gold as an alternative currency, and they will consider the gold as an inflation hedge too, especially when the inflation is triggered by the excessive printing of the money, like what is happening now. So this is the summary and the introduction of the inflation. If you like the video, please click the like button and subscribe my channel. And see you soon. Thank you.